Hi everyone. This lecture covers chapter 3. After this chapter, you should essentially be able to prepare the financial statements. This is a pretty critical chapter. Future accounting classes that you take, a lot of the material there really is based off of what's called accrual accounting and income. So let's dive right in. We'll work through a bunch of examples here, and please come prepared to class with questions. So in this chapter, there's really 6 things that we want to cover. One is we want to understand and explain how accrual accounting is different from cash basis accounting. So what is the difference between the two? Apply the revenue and expense recognition principles. So what are the rules under which we actually recognize revenue or an expense? We're going to do a process called adjusting the accounts. Then we'll actually construct the financial statements. Finally, we'll close the books. And then at the very end, we'll do a little bit of analysis. In this case, we'll be evaluating a company's debt paying ability. So first, let's just look at how accrual accounting differs from cash basis accounting. So here's the major kind of comparison between accrual accounting and cash basis accounting. So in accrual accounting, we're really recording the impact of transactions when they occur, right? It's very important to note that accrual accounting is what's required by generally accepted accounting principles, which is GAAP, right? These are all the rules that we're learning in this class. So you must follow accrual accounting. The key here is that it records revenue and expenses when incurred. So how is that different from cash basis accounting, right? So cash basis accounting will only record transactions when cash comes in or cash goes out, right? This really ignores a lot of important information, because if you're just focusing on cash, then you're ignoring a lot of different transactions, many of which we'll cover in this chapter. And so the result is that you get incomplete financial statements, right? So what we find is cash basis accounting is really only used by the smallest of businesses, a hair salon, a family-owned restaurant, things like that. Every major company will generally use accrual accounting. So it's important to note, accrual accounting records cash transactions, right? So you're still if you collect cash from customers, that's a debit and a credit under accrual accounting. If you receive cash from interest earned, if you pay salaries, rent, or any other expenses, if you borrow money, if you pay off loans, if you issue stocks. So accrual accounting still records all cash transactions. The main difference is it also records transactions that may not have a cash component. And again, we're going to look at a lot of those in this chapter. So here's some examples of non-cash transactions that accrual accounting will record, whereas if we used cash accounting, these would not show up. So things like sales on account, right? Purchasing inventory on account. Just as a reminder of what on account means, it would mean I'm buying something, or if I'm buying something from another provider, it's an account payable. And if somebody owes me money, I provide a good or a service and they owe me money, that would be an account receivable. So most of this chapter is going to talk about things like accruing expenses that are incurred but haven't been paid yet, right? Another example is depreciation expense. Depreciation expense is really just an accounting thing. There is no cash that gets affected by depreciation expense. Using up prepaid rent, insurance, or supplies. And earning revenue when cash is collected in advance. So if you go work for an airline, usually you pay for your ticket before you actually take the flight, right? So how does that look when the airline does its accounting? So we've kind of touched base on this already, but just as a reminder, accounting follows the time period concept, right? Meaning accounting is reported at regular intervals. Most of the time, we see this as 1 year. If you go work for a startup that's just raised money, you may do financial statements on a weekly basis just because you have to know how much cash you have left um, for when it's a new company. But most large companies do official statements once a year. They might do some in the interim periods, but audited, properly done financial statements are usually done once a year. Many companies, about 60%, will use January 1st through December 31st as their fiscal year, right? So fiscal means like financial year. January 1st to December 31st is thought of as a calendar year, right? That's how we think of a year on the calendar. But keep in mind, you don't have to. The other 40% of companies, they can use any, may end on any date other than December 31st. As long as it's a 12-month period, your fiscal year can be, any period, starting on any date, going into any date. And again, there are some interim period prepared financial statements. Quarterly is very common. Less common is monthly, and even less common is weekly. But if you work in the Bay Area with startups, you might see weekly and quarterly. So let's talk about the revenue and expense recognition principles. So revenue principle deals with two issues: when to record or recognize revenue and what amount of revenue to record. Now let me be clear, you can take an entire semester class just on this slide, just on revenue recognition. This is a major, major topic in accounting. We are obviously just going to brush over very broadly what it means. So really we have just this definition, that revenue is recognized when the business transfers promised goods or services to a customer in an amount that reflects the cash or fair market value of other consideration that the entity expects to receive in exchange for those goods and services. Okay, so basically I have provided promised goods or services to a customer, right? And it reflects the cash they give me or the fair market value of something else that they give me. A customer might pay me by simply giving me their car, for example. So the fair market value of that car that I expect to receive in exchange for those goods and services that I provided, okay? So again, revenue is recognized when it is earned, not when the cash is collected, when it is earned. The expense recognition principle says that expenses are recognized when they are incurred, right? Again, not when they're paid, but when they are incurred during the period. So we measure the expenses and recognize them in the same period in which any related revenues are earned. This is really important. The idea is, let's take Disneyland. So Disneyland, at the time of this recording, is finishing up its Star Wars exhibit, right? Any revenues that are associated with that Star Wars exhibit should match when expenses are incurred for that Star Wars exhibit. And we'll see that come up here shortly when we talk about depreciation expense. Because obviously that Star Wars exhibit is going to generate a lot of revenues in the future once they finish building it, right? 1 year from now, 5 years from now, 10 years from now. So the expense of building it should be spread out over its useful life. We shouldn't take the entire expense of building the Star Wars exhibit and expense it this year or next year, because we're going to get revenues from it. And so this is really important, that we want to match the periods between revenues and expenses. So here's a little bit of a visual, right? This is just looking at a given period, and it's just saying revenues minus expenses equals our net income, right? Or if expenses exceed revenues, then we have a net loss, right? And the idea here is just that the same period that we earn these revenues, the expenses that are associated with generating this 1,000 in revenues should be recognized in the same period. And same thing here. So now let's talk about adjusting the accounts. Right now, we've created this last chapter, we created what is called an unadjusted trial balance. This was where we just listed out all the accounts and put what the net balance was from the ledger, right? So we looked at the ledger, we looked at the cash account, and the cash account had a debit of 36.8. So we just wrote cash and then took the 36.8 on the debit 36.8, right? This was just a copy and paste exercise. So this is what we call an unadjusted trial balance, To have an adjusted trial balance, we have to do some adjusting journal entries. So first, let's just quickly look at some definitions, but let's dive right into examples because I think the examples are much more helpful than just looking at the definitions. So a few words you have to learn here: deferrals, depreciation, and accruals. So a deferral is an adjustment for payment of an item or receipt of cash in advance. Okay. Depreciation is just allocating the cost of a plant asset to expense over the asset's useful life. And accrual is just the opposite of a deferral. Again, let's just look at some examples. I think it makes more sense as you start going through examples and problems. So let's look at prepaid expenses. What is a prepaid expense? Well, for you in your normal life, let's say you rent an apartment, right? So if I rent an apartment, generally the landlord wants, let's talk about January rent for your apartment. When do you usually pay January rent for your apartment? Most landlords want it by something like January 5th, right? And that's when you're paying rent for the entire month, for January 1st through 31st. So let's say your apartment building were to burn down, right? You get a big fire and it burns down on January 10th. Technically, you prepaid your rent when you wrote the rent check on January 5th. So you would want some money back, or you would want to have another apartment made available to you. If you had to move away, you would want to go to your landlord and say, hey, you owe me from January 10th to the 31st my money back, right? I want my money back. And so that's an example of an expense paid in advance, your rent. And obviously that is an asset because you're going to get a future benefit. You paid rent, now you can use whatever it is you're renting for the rest of that month or period. So here's an actual example from a company that we've been working with. This is an imaginary company in the book called Aladdin's Travel Inc. Let's say that Aladdin's Travel prepaid 3 months of the store rent, $3,000 on June 1st. So what did that journal entry look like on June 1st? So June 1st, you had a prepaid rent account. This is an asset account. And you paid for this prepaid rent with cash, right? Also an asset account. So we're debiting $3,000, increasing this asset called prepaid rent, and we're crediting $3,000, decreasing an asset cash. And what was the transaction? We paid 3 months rent in advance. So we're going to have this ledger account called prepaid rent, debit $3,000. Now, what happens? The month of June passes by, right? So we're at the end of June now. Now we're at June 30th. We need to do an adjusting journal entry. Why? Well, because once we hit June 30th, we have now used up 1/3 of this asset, right? Because $3,000 was for June, July, August. Well, June has now passed by, so we use up 1/3 of this asset. So we're gonna expense it. We're gonna have a rent expense of $1,000, right? And then we're gonna decrease this asset prepaid rent by $1,000. You see, we're crediting it, we're decreasing it by $1,000. So if we go down to our ledger account, you'll see prepaid rent, we credited for $1,000. We're left with $2,000 in this account. And this rent expense, we increased by $1,000. Remember, an expense account is stockholders' equity, but it's a contra account. So we increase it by debiting it, right? So rent expense is now $1,000 higher. And this will repeat for July and August. Here's another example. June 2nd, we pay cash of $700 for some cleaning supplies that we buy. Well, we're going to debit a supplies account, an asset, right? We increase it by $700, and we're going to decrease cash by $700, an asset. Now we get to June 30th. We open the supplies drawer and realize we have $400 worth of the supplies still on hand, meaning we used $300 worth of supplies. So what do we have to do? Well, we have to expense that. So we have a supplies expense for 300, the amount we used, and we're going to decrease our asset supplies by 300. Okay, so if we go to our ledger account, we have supplies. We started with 700, right? We used up 300. Now we're left with 400. And this used up 300 went to an account supplies expense, right? Stockholders equity account. It's an expense account. Contra. So we are increasing it by debiting it 300. Let's talk about depreciation of plant assets. So things like property, plant, and equipment, the Star Wars exhibit at Disneyland, those are long-lived tangible assets, right? Is the way we think about it. Tangible being you can touch it. Think of it like that. You can touch it. So depreciation is how we allocate the cost to expense for a long-term plant asset. Why do we use depreciation? Well, it declines in useful items that are property, plant, and equipment will decline usually in usefulness. We want to spread the cost of the asset over its useful life. This is important. Again, we want, given the matching principle, we want to match expenses to the period that the revenues are generated. So if Disneyland spends $100 million building the Star Wars exhibit, and they think that the Star Wars exhibit will be good for 10 years, they're going to take $100 million, divide it by 10, and $10 million each year they're going to expense, right? So they don't expense all $100 million when they build it. They do it over time. There's one big exception for depreciation, land, okay? Land does not get depreciated. So always remember that. There is no depreciation for land. So let's look at an example here. Suppose June 3rd, Aladdin Travel purchases equipment on account for $24,000. What's the journal entry? Well, you increased your equipment account and you bought it on account. So buying on account means you owe it account payable, liability goes up by $24,000, and an asset, equipment, is a debit $24,000 on June 3rd. Right? So in the ledger account, our equipment account is going to increase by $24,000. And of course, they don't show it here, but your accounts payable account is also going to have a credit of $24,000. So let's look at how depreciation gets calculated. There are a couple of techniques, and we will go into detail in them later on when we have a whole chapter on property, plant, and equipment. For now, let's just look at one example of straight line depreciation. This is a very common one used in the real world. So what you're doing here is dividing the cost of the asset by its useful life. So in this case, Aladdin Travel bought some equipment. It cost them $24,000, and they estimate that the useful life is 5 years. So each year, they're going to depreciate $24,000 divided by 5 years, $4,800 per year. Another way to think about it is if it's monthly depreciation, you're going to take $4,800, the per year amount, divide it by 12, and that gives you $400 per month. So you're just taking this number up here, divided by 12, and that gives you $400 per month. So if we are doing adjusting journal entries every month, in this case for June, so June 30th, we are putting in depreciation expense equipment of $400. And here's kind of a new account to introduce you to. Rather than directly hit the equipment account and decrease it by $400, what we do is we create kind of a sister account. This is going to be a contra asset account that we call accumulated depreciation and tie it to the specific item that we're depreciating. So this way, when I look at my ledger, I still have the original equipment account, right? Whatever amount I paid for it, in this case it was $24,000. And then I'm gonna have this accumulated depreciation equipment account next to it. So accumulated depreciation, I'm just using some shorthand for equipment. And I'm going to keep track of that here. And so this way, I don't want to muddy up the accounts. I can keep them separate, but I know I'm essentially with accumulated depreciation, I'm slowly writing down the net book value of this equipment down to zero, right? So that will be important, the net book value. We'll look at that more in detail later. So again, this accumulated depreciation account basically shows the sum of all the depreciation expense. This balance will increase over the asset's life, right? You keep doing depreciation every period. You keep building up, you keep accumulating the depreciation. It is a contra asset account, so it normally has a credit balance. Back to this example, you see it goes on the credit side, right? As a reminder, a contra account has two key characteristics. There's always a companion account. In this case, our companion account is the equipment account. And a normal balance is the opposite of that companion account. So if we go back here, equipment has a normal balance of debit. Accumulated depreciation equipment has a normal balance of credit. And what I just mentioned, book value, an important definition. This is just the cost of the plant asset minus accumulated depreciation. So on the financial statements or in the footnotes, you'll see you put the original cost of the equipment. That's the historical cost principle. Remember from chapter 1, historical cost principle. Oh. And then you'll have less accumulated depreciation. In this case, we only have 1 month, June, of accumulated depreciation. So our book value for this equipment is $23,600. Land does not get depreciated. So let's define accrued expenses now. Accrued expenses is a liability that comes about from an expense that has not yet been paid. So again, using a real world example, if you have a job, you work, let's say you worked today, your boss owes you some money, but usually when you're leaving work, they don't hand you money, you wait every 2 weeks and get a check. So your boss has an accrued expense. They owe you, they have a salary payable that they owe you, right? These are not recorded in the books daily or weekly, but just at the end of the period when you're doing adjusting entries, right? Which is what this chapter is all about. So the example I just gave you in real life, let's look at it for Aladdin Travel. So say Aladdin Travel pays its employee a monthly salary of $1,800. Half goes on the 15th, half is on the last day of the month, right? Let's assume that if a payday falls on a Sunday, Aladdin won't pay until the following Monday. So what happened here? Well, the 15th is on a Saturday, so they're going to get paid. The last day of the month here happened to be on a Sunday, which again, that means it's not going to get paid until Monday, based on what it says here. So what happens? Well, June 15th, we're going to have salary expense of $900. We paid half of the employee's income. Where did $900 come from? Monthly salary of $1,800, half of it on the 15th. So that's $900. And then we'll pay them in cash, $900, right? So our account salary expense in the ledger goes up by $900. This one, right? And then they don't show here, but of course cash is going to go down by $900. Now the second half of the month, the other $900 won't get paid until Monday, July 1st. But if I'm closing the books on June 30th, I must show in my books that I owe this $900. So how am I going to do it? I'm going to recognize the salary expense because I incurred it already of $900. But instead of cash, I'm now crediting salary payable of $900. Right? So my liabilities went up because I'm not going to pay this $900 in cash until the next day. Let's look at accrued revenues. So accrued revenues, it's a revenue that's been earned but not yet collected. So let's do an example of what that means. So assume that on June 15th, a hotel is going to pay Aladdin a commission of $600 for booking 100 clients over the next 30 days. During June, Aladdin books 50 clients. The other 50 they book in July, right? So In June, Aladdin will earn half that month's fee because they satisfied the requirement, but the hotel isn't going to pay them until the end. So how does Aladdin recognize this at the end of the month of June? So if they're closing their books and need to do adjusting journal entries at the end of June, what are they going to need to do for this transaction? Well, the half of the fee that they earned is going to be an account receivable. The hotel owes them $300, and they can recognize revenue of the $300 that they earned already, because again, the revenue recognition principle is we recognize revenue when it is earned, okay? And they earned it because they did, see, they will earn half the month's fee of $300 because they did that work in June, right? They booked 50 clients in June. What about unearned service revenue? What if the opposite happens? What if you receive cash before you actually earn the revenue? Well, then you have what's called a liability. So the account unearned revenue, many people think that this is a revenue account because it has the word revenue in it, but this is actually a liability. So let's look at an example. Let's say that the Disney World Resort gives Aladdin Travel $400 each month immediately, right? And the deal is they must book up to 8 clients into the resort within 30 days. So Disney gives Aladdin June 15th this cash of $400, but Aladdin hasn't booked the 8 clients yet. So they can't just book service revenue. They have to book unearned service revenue. This is a liability. They owe Disney World Resort 8 clients. So until they satisfy that, they have this liability. So you have this unearned service revenue account in the ledger that now has a $400 credit balance. So during the last 15 days of the month, Aladdin Travel books 4 clients into Disney World Resort to earn half of the fee. So assuming that they've earned half of that $400 fee. So June 30th, they're closing the books. They need to do their adjusting journal entries. If they've booked 4 clients, that $400 fee, now they've earned half of it. So half of it they can show, right? So they can get rid of one half of this liability, unearned service revenue, and show it as service revenue, a stockholder's equity account. So you'll see the unearned service revenue liability, this is liability, goes down by 200, and so we have 200 as the balance. And service revenue, a stockholder's equity account, is going to increase by 200. So the holding balance for this period is 7,500. So here's just an example of prepaids. I'm not going to go through this all. You can kind of, this is just coming straight out of the book. So you're welcome just to take a closer look here. And it shows you, what happens when you have prepaids, cash first. What happens when, you first pay cash and record an asset. And then what happens later on, you're going to record an expense and decrease that asset, right? So you can follow these examples for prepaid expenses, unearned revenues, accrued expenses, accrued revenues. So just get comfortable with these journal entries. You need to know these and follow them closely. So let's summarize this whole adjusting process, right? There's 2 purposes of why we even do this. We're trying to measure income and update the balance sheet. We're basically closing the books and we want to update all of the accounts. So it's important to note that every adjusting entry is going to affect both a revenue or expense, because it's going to measure income, and an asset or liability. It's going to update the balance sheet. So here's another summary graphic from the book that you can spend some extra time in to see what kind of account is a prepaid expense, right? So you're debiting it for an expense. You're going to debit an expense account when you're doing this adjusting entry. You're going to credit an asset account when you're doing depreciation. You're going to debit an expense account, credit a contra asset, and on, right? Income tax accrual. So you also, if you think about it, you pay taxes around April 15th, at least in the United States. For those of you who have filed taxes, taxes are due around April 15th. but your calculation for how much you owe in taxes is actually final as of December 31st of the previous year. The IRS simply gives you a few months to do your calculations and send in any money that you owe them. So if you're closing your books, let's say as of June 30th, if you know that you're going to have some income tax based on the transactions that you did in the month of June, well, you have to accrue so you have to show an income tax expense and accrue an income tax payable, right? So this is accruing income tax expense. Again, no cash here, but you have to show that based on the money that I made in June, I'm going to owe some income taxes, right? So I have an expense and a payable. Here is, again, a review of all the different things we did up till now. We did a bunch of different journal entries here. So these were the transactions, and here were the journal entries for those transactions. So please review this slide. Again, this comes straight out of the book. So when you're reading the book, go in here, take a look, make sure this makes sense to you. And here's the ledger account for all of these different transactions that we've been doing, right? So again, trace each journal entry to the ledger. You see you have these letters. A was prepaid rent of 1,000, and the other one is going to be the rent expense, right? So make sure you can trace the different transactions and you see how this all fits in. So spend some time on this. So now we can prepare what's called the adjusted trial balance. So it summarizes all the accounts just like before and their final balances after we've done the adjusting journal entries. So when people look at this at first, they get really kind of overwhelmed at times, right? So on this Excel sheet, but don't freak out too much. Just take a moment, let it sink in, take a look at it. If you look, this is just broken up into 3 sections. So we have this section which we showed at the very beginning of this lecture. This right here was the trial balance before we did any journal entries. This was, like I showed you guys, this was just copying the cash account and the 36,800 that was in it. Now, throughout this lecture, we've been doing a bunch of adjusting journal entries, right? Based on accruals, deferrals, all that good stuff. So what we're doing is taking these adjusting journal entries. So let's just use example A. What we had was we had prepaid rent, right? We had some prepaid rent that we had done at the beginning of this section, and then we had to do an adjustment. We went through the month of June, so we used up $1,000 or 1/3 of the $3,000 of rent. So we credited prepaid rent to decrease it down to $2,000, and we had an account called rent expense that we debited to show an expense of $1,000 for rent expense. So all you see, before we didn't even have this account, there was no value. Then we debited it for $1,000 when we did that journal entry. So now in our ledger, in our adjusted trial balance, in our ledger, we have this debit of $1,000 under rent expense. Okay, so that's all you're really doing. You're just taking, so if you go to B, remember we used up supplies. We bought some supplies. We had 700 of supplies before. We used up 300, so we need to decrease that 700 by 300. So if I look at the adjusted trial balance, I now have a debit of 400, right? And we have this new account, supplies expense. Before there was nothing there, but we had a debit of 300. So now the adjusted trial balance shows this debit of 300. So as you can see, we had our unadjusted trial balance. We did some adjusting journal entries. Now we have our adjusted trial balance. And this is the information that we have and we need to prepare the income statement, the statement of retained earnings, the balance sheet. So now we can actually construct the financial statements. So from the adjusted trial balance, we can now prepare the June financial statement for Aladdin Travel. So if you go back and look at the transactions and look at all the accounts, you'll see that the service revenue account had $7,500, so that was our revenue. You'll see that we had a bunch of expense accounts. Here they all are. They total up to $4,000. So our total revenues minus our expenses of $4,000 gives us income of $3,500. But remember, we had an income tax expense of $600, so we have net income after tax of $2,900. Where does that 2,900 go? Well, of course, into the statement of retained earnings. Our beginning retained earnings was 18,800. We now have net income of 2,900 this period. So we have a subtotal of 21,700. We have to subtract dividends. We paid out 3,200 in dividends. Our ending balance of retained earnings, 18,500. Where does that go? Well, the balance sheet, of course. So if we look at the balance sheet, again, this is just pulling all from that adjusted trial balance. Go back to the slide that shows the adjusted trial balance and you'll see all these figures, right? You see now we introduced accumulated depreciation. So you can see we have now our carrying book value is 23,600 for the equipment, right? And so the retained earnings came from the slide we just completed. And you can see the balance sheet balances. And so now we need to close the books. Closing the books sounds much harder than it really is. Effectively, all we're doing is taking some temporary accounts, which are revenues, expenses, and dividends, because they're related to a specific period of time, right? Specific period. So we want to start at 0, see what happens during that period. We end up with some value. And then for the next period, we want to zero this value out and start fresh again, right? We will not close permanent accounts. Assets, liabilities, stockholders' equity, balance sheet types of accounts. These are cumulative accounts, right? They accumulate over time. So they're ongoing balances, different than revenues, expenses, and dividends, which we're tracking over a period of time. So here are the steps to close the books. So this is just an important slide to know. You're going to debit each revenue account for the amount of its credit balance. So if the revenue account is 500, we are going to debit it 500 so that we go to 0 in it, right? We want to zero them out. You're going to credit each expense account for the amount of its debit balance. Okay. The opposing journal entry, so remember, you have to have at least two accounts for every journal entry. So when you debit a revenue, you're going to credit retained earnings. When you credit the expense account, you're going to debit retained earnings. Then you're going to credit the dividends account and debit retained earnings for that amount. So basically, this is where your revenues, expenses, and dividends all get sucked into retained earnings. So for our example here, here were the journal entries for closing the books, right? The closing entries. Service revenue, we're debiting 7,500 to zero it out. We're putting that 7,500 into retained earnings. Expenses, we're crediting them to zero out all the expense accounts, and we are debiting retained earnings for the total. Dividends, we are crediting to zero out the dividends account in the ledger, and we are debiting retained earnings for the total. So you can utilize this graphic just to see, this is just saying, again, here I did the closing journal entry for service revenue of 7,500. That debit of 7,500 to service revenue is a credit of 7,500 to retained earnings, right? So you can see that just what I said a second ago. Expenses, service revenues, and dividends are all getting sucked into retained earnings. And so again, here's closing the books. If we look at retained earnings, we have our beginning balance, we add our revenues, we subtract expenses, we subtract dividends, it gives us the ending balance of retained earnings. We talked about this a little bit already in class, but here's another discussion around assets and liabilities based on liquidity, right? So we list assets and liabilities or classify them based on liquidity, right? And again, the definition of liquidity is a measure of how quickly an item can be converted to cash, right? So cash is obviously the most liquid. Accounts receivable is generally next. It's quite liquid. Inventory is a little less liquid, but more so than things like equipment and buildings, right? Those are even less liquid, much harder to turn into cash quickly. So current assets are the most liquid assets. So if we look at current assets, those are the most liquid things. Something that can be converted to cash, sold, or consumed within a year or a business operating cycle. So companies like Boeing that build airplanes, for example, generally have an operating cycle, or from the moment an order is taken until the moment I collect the money from delivering on that order can be more than a year, right? It takes them a while to build the planes and then get the customers to pay. So examples of current assets are things like cash, short-term investments, accounts receivable, prepaid expenses. Those are things that we expect to use up within a year, or we can convert to cash very quickly. Long-term assets are just things that are not current, things like property, plant, and equipment. So some examples would be land, buildings, furniture and fixtures, equipment. Current liabilities, so same concept, just talking about liabilities, a debt that needs to be paid within 1 year or within one operating cycle if it's longer than a year. Again, using the example of Boeing. So current liability examples would be things like accounts payable, notes payable that are due within a year, salary payable, unearned revenue, interest payable, income tax payable. All of these things we expect to pay within a year. Long-term liabilities are just liabilities that are not current, right? So there's notes payable that are generally long-term. So here's just looking at the Walt Disney Company balance sheet, and you can see they kind of break this up. So you can see how they list current assets, right? And then they do a subtotal of total current assets. Then they do long-term assets. They don't do a subtotal of long-term assets, they just do total assets. So they just add up all the current assets plus all the long-term assets and get total assets of 92,033. Again, this is in millions. And then current liabilities, right? And they do the same thing with liabilities, and then they have equity and total liabilities and equity 92,033. So it balances, which it should, both for 2016 and 2015. You can see that the balance sheet balances. So take a look at this. This is a real world example from the Walt Disney Company of a balance sheet. There's a couple different ways that you can format the financial statements. So the balance sheet, there's a report format or an account format. Income statement, you can have what's called a single step or a multi-step. So this is the Disney Company in a multi-step format. Basically, it's just breaking things up and doing subtotals, right? So in this case, you're looking at, it breaks up revenues into different categories. So revenues from services and from products. Then it breaks up the cost of those revenues. So what did it cost to deliver those services? What did it cost to deliver those products, right? And so then it subtotals the total costs of services and products, right? So you have this subtotal of revenues, then total costs of services and products. If we take the difference of these two, we get this 25,639. That's called the gross profit on services and products. Then we have other expenses called selling, general, and administrative. Very often you'll hear these as SG&A, selling, general, and administrative expenses. Then you have depreciation and amortization. That gives you your income from operations. So this is the income we made from our regular operations. Then we'll have other income. So we get like 111. Maybe this is from interest, money that's sitting in the bank, or maybe we get some lawsuit that we win and get paid out, whatever the case may be, but it's not really in our standard operations. So then we get income before income taxes, we pay income taxes, and we get our bottom line net income. So that's what they say by multi-step. There's these subtotals in various places, right, that happen. It just breaks it up more. So finally, for this chapter, let's analyze and evaluate a company's debt paying ability. So I've told you in class, it's really important that you get comfortable doing analysis and accounting. That's really what takes you to the next level in a career in finance and accounting. Yes, the journal entries are important and knowing the rules is important, but frankly, you can Google those on the job. What you really need to know is how to draw conclusions from the information that you're given. And they still haven't figured out a way to have computers do that. Humans still need that to be able to understand the nuances of all of this information. So let's look at, we're going to just start introducing in this class some concepts. The most common concept is something called net working capital. All this is it's just subtracting total current liabilities from total current assets, right? It gives a number. So if my total current assets are 1,000 and my total current liabilities are 800, that means my net working capital is 200. Now that's not very helpful because a company like Nike or Disney might have a much higher absolute number. Like this might be 200 million, whereas a small company, this might be 200,000. And so then the question is, which is better? Well, it's hard to say because absolute numbers are tough to compare. So it's much better to put this into a ratio, and we call this the current ratio. So rather than subtract total current liabilities from total current assets, we're going to divide and get a ratio. That means it doesn't matter if you operate in thousands or in millions or in billions. It really doesn't matter. We're going to get a ratio. So most successful businesses, just to give you a sense of what is an appropriate ratio when we divide total current assets by total current liabilities, somewhere in the neighborhood of 1.2 to 1.5. It doesn't have to be there. Apple has a current ratio of less than 1 more often, and we can discuss more in detail at a later date why that is. But just understand that 1.2 to 1.5 is kind of a reasonable figure for, obviously you want to have more current assets than current liabilities, otherwise you might be on the brink of bankruptcy. So another thing is debt ratio. So this kind of measures debt paying ability. It's just dividing your total liabilities by total assets, right? So again, if I have total liabilities of 100, what are my total assets? Hopefully 200. Hopefully I have some equity in the firm, right? So around 0.5 would be my debt ratio in this circumstance. Obviously, the lower the debt ratio, the better, right? It's safer than a higher debt ratio. I wouldn't want to have total liabilities of 200 and total assets of only 100. I'm essentially bankrupt. That would be a ratio of 2. Finally, what you need to practice doing, and again, this kind of goes into really, once you start understanding accounting, being able to do analysis. How do transactions affect some of these ratios, right? So if I issue stock and receive cash of 50 million, how is my current ratio and my debt ratio affected? Well, my cash increases. In this case, I'm issuing stock, receiving cash of 50 million. So my current assets go up by 50, right? And my stockholders' equity goes up by 50. So my current ratio is current assets over current liabilities. In this transaction, current liabilities is not affected at all. Current assets goes up by 50, so my current ratio improves, right? My debt ratio, my liabilities here do not get affected. My total assets go up by 50, so my debt ratio decreases a little bit, so that it improves as well, right? Current ratio increases, so it improves. Again, current ratio, you want it to be higher. Debt ratio, you want it to be lower. Go back to the earlier slides if that doesn't make sense. What about if I buy some buildings? So in this case, a long-term asset is a building. It goes down, it goes up. And a short-term asset, cash, short-term asset, goes down by 20, right? So my current ratio, my assets go down by 20, so my current ratio goes down, so that's not good, that's bad. My debt ratio, well, my one asset goes up by 20, the other asset goes down by 20. So because I'm looking at total assets here, current and long-term. So there's no change. My liabilities don't change at all, right? There's no liability account here. Let's say I made a $30 million sale on account. So a current asset goes up by 30, and my stockholders' equity goes up by 30. So current ratio, the numerator goes up by 30. This goes up, it improves. My debt ratio, my total assets go up by 30. Liabilities are not affected at all. So this goes down, also improves. And that makes sense, right? If I'm making money, if my company is selling and making money, that's a good thing. What if I collect the account receivable of 30 million? Well, this is really just one current asset, cash, going up by 30, and another current asset, accounts receivable, going down by 30. right? So the net effect is nothing, but the ratios are unaffected. What if I have some expenses at the end of a period? Well, I increase my expenses by 40, that stockholders' equity goes up by 40, and expenses payable, a current liability account, goes up by 40. So my assets, my current assets don't change. My current liabilities go up by 40. So my current ratio goes down, right? So bad. My debt ratio, the liabilities increase by 40. Assets, nothing happens. So this goes up, also bad, right? So expenses, bad. Revenues, good. What about recording some depreciation? Well, I'm going to have depreciation expense, stockholders' equity, goes up by 80. Accumulated depreciation, asset, contra. Remember, accumulated depreciation is tied to the asset, a long-term asset, so it's also a long-term account. So that goes up by 80. So my assets, my net assets here, go down by 80, but these are long-term assets. So my debt ratio is affected, okay? And my debt ratio increases, so that's bad. Did I say that on the, yeah. And then on current ratio, current assets over current liabilities, well, no current assets and no current liabilities are affected, so this doesn't get affected, right? Nothing changes here. What if I earn interest revenue and collect cash? So cash goes up, it's a current asset, by 40. Interest revenue goes up, that's stockholders' equity, goes up by 40. So in these ratios, current ratio and debt ratio, all that happens is my current asset goes up by 40 and total assets go up by 40. So this goes up, good, right? This goes down, good. So again, earning revenue and collecting cash is generally going to improve what your company faces. So that's it in this chapter. Again, this is a key chapter, and really the end of our first section. So please read this chapter. Please watch these slides. Please review the slides. Please come to class prepared with questions. It's very important that you understand this chapter so that from here on, everything else makes sense. Starting in chapter 4, we're going to dig in. We've now basically completed preparing the financial statements. So starting the next chapter, chapter 4, we're going to start digging into the individual